இந்த வீடியோவில் பார்க்க போகிறது margin of safety related quote. There are three important words in investing. It's nothing but margin of safety. For example, ஒரு bridge வந்து ஒரு engineer கட்டும்போது 10,000 tons capacity bridge கட்டும்போது they build it for 12,000 tons capacity. Then they advertise it or put a board saying that this bridge cannot carry load more than 10,000 tons. So the 2,000 tons on that's margin of safety. It's for taking into account the wear and tear that can happen, or if there are any flaw in the design. So அதை compensate பண்றதுக்கு they have a margin of safety of 2,000 tons. Same thing is applicable while investing too. So for example, when you invest in a stock, you do the valuation and find out the intrinsic value. Then you look at the price. If you are actually, if the price is same as the value, then you should not actually invest. The reason being that the assumptions that you may have done during the valuation of the stock or the calculations that you have done may go wrong. There could be some error or the times could be uncertain. So in order to compensate for that, you have to actually buy the stock at a price which is lesser than the value of the stock. So how much the price need to be less than the value of the stock to compensate for these uncertain events? So that's nothing but the margin of safety. For example, if the value of the stock is 200, I should not buy the stock at 200 price. Rather, I should buy the stock at 160 or 180, depending upon the uncertainty. Next quote is about buying a stock at a high price. So if you buy a stock at a high price, it can actually undo the favorable business developments that will happen in the future. Let's say you are buying a stock when the P ratio is quoting at say 50, then it's a very high valued stock. If you're going to purchase that stock, whatever developments that is going to happen in the future, so you're paying for that. So net result will be zero returns. So the best way is to actually purchase the stock when it's actually quoting at a low price. Choose a stock and then wait for the price to come down, say to a PE of 20 or something, then you purchase the stock. So that will be the better method. Third quote is volatility is your friend. It's not your enemy. What it means is you should actually treat volatility as your friend. Basically, when people are selling, you should actually buy the stock. You should actually choose a stock. You should analyze the stock and find the value of the stock, and then wait for the volatility to actually take place, and then purchase the stock at a low price. So that is what it means. Volatility is my friend. Is your friend. It's not your enemy. The fourth quote is price is what you pay and value is what you get. What it means is you should not actually focus on the price of the stock. You should actually focus on the value of the stock. If you do the valuation of the stock correctly and purchase the stock with the margin of safety, then the price will actually follow the value. Price is what you pay and value is what you get.